Well, we had one of our first true risk-off days that we've had in a while. I'm going to put today's selling in context to see how bearish it is and what to expect now heading into next week. Remember, this is a seasonally bearish or higher volatility time for the markets heading into the end of August. We're going to see what the charts tell us right now to expect. I'm also going to break down what's really driving this action today. And it was a breakout move that caused this, and what that breakout move does going forward, and how we can add some bearish balance to an active trading portfolio and do so in a very strategic, tactical way. So let's go ahead and get started. Today is Friday, August the 10th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over the Market Scholars logo right here in the bottom right corner of the video. Click that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That tells me two things. It tells me, David, I liked it. Please keep doing the videos. It's a one-click, very easy way for us to get feedback on what you think about these. Also, comment. Scroll down further and comment on anything that stands out to you. Join our Market Outlook daily email list. There's a link popping out in the top right corner of your video. Click that link and subscribe. And then follow me on Twitter. Excuse me, can't remember what to say next. Follow me on Twitter for more content like this, and join our Market Outlook community on Facebook. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator, and you see the intermediate posture. So we had a pullback today. You know, no surprise, right? No, we had a pullback today. The momentum line actually came out, just barely stayed inside the lower reversal zone. So it's actually 3 consecutive days of a bullish intermediate confirmation signal. Of course, these 2 days here, you had hardly a downward decline at all. But this one, obviously now we do have a pullback. In fact, these Fibonacci lines you see up here is the price dropping to the 50% Fibonacci retracement of this near-term bullish rally that we had off this near-term low point down here. Now we didn't get 7 days. We only got, let's see, how many did we get? We didn't get one there, so that was really close. 1, 2, 3, 4, 5, 6. No, that one was a little bit. So we had 5 days in the upper reversal zone, with 1, 2 on either side of those 5 days, just barely below the 50th percentile. So we didn't quite get that 7 to 12 day expected near-term move. But now the near-term line has pulled back and dipped its toe underwater for a second time. See, the last time it did that right here too, bullish intermediate confirmation signal, and that ended up being the bounce up to a new high. So that's kind of where we're at right now, even market sentiment. So despite the pullback despite the Fibonacci pullback on a short-term basis, as bearish as today seemed, despite it only being a Fibonacci pullback on a short-term basis, the the intermediate posture and long-term market sentiment are both strongly bullish still. So that kind of puts in perspective again. Seems like every time we go down, I have to put in perspective that selling. So it's not as bearish as it seems, considering that we're still on this bullish intermediate posture. That green line continues to point higher. The green is green because we're above a rising moving average. So strong bullish posture, strong long-term trend. Short-term pullback that still could be considered a buying opportunity on a short-term basis, because even this would still be considered a higher near-term low point. We take a look at the Dow Jones Industrial Average. It looks very similar to the S&P 500. It's a little bit closer to that prior low point. It did not stay up above 50 as long as the S&P. It's been a little bit weaker, but you can see the same pattern, dipping its toe underwater. The momentum line almost producing an extreme low point, and then also staying just a smidge below 20. But then that's it. Those are the large cap indexes, the ones that are most impacted by the strengthening dollar. On the other end of the spectrum, you look at the NASDAQ, and the NASDAQ actually looks pretty bullish. The long-term posture is bullish, or excuse me, intermediate posture is bullish. Long-term market sentiment's dipping a little bit below 80, so it's a little bearish. It's about as weakly bearish as you could possibly get. The momentum line dipped its toe underwater, so that is a bullish intermediate confirmation signal with the near-term line between 20 and 50 and setting up the possibility of a bullish near-term low point, a higher low that corresponds to a to these lows here on the market forecast down below. So finally, the Russell 2000, which was the least bearish of all the indexes today, only down 0.25%. You can see its intermediate line is actually still rising. It's not in the reversal zone yet because it's been catching up, but it's still rising, and you can see hardly a pullback at all on a near-term basis when you look at it relative to the prior move. So when you look at short-term sentiment, the near-term line is actually still in the upper half of the chart. So you see how the charts have gotten progressively less bearish as we've progressed from the S&P to the blue chip index to the NASDAQ and now the Russell 2000. So the short-term sentiment looks pretty bad, especially in the large cap stocks because of that strengthening dollar, but not bad enough to suggest, man, this is it. The bullish trend is done, and now we need to start looking at some bearishness. Now, it doesn't mean that we can't look at some bearish positions. In fact, the trade we'll look at today is a bearish trade that we can look at to offer some balance to our active portfolio, but it's not one that we're making because we think things are really going in the tank for the broad market as a whole for the near term. In fact, we're still coiling on this, on the small cap index with these lower highs and higher lows. We're still coiling here, and the expected move out of that coil or symmetrical triangle would be the same move you had coming into it. So there's the move you had coming into it. You would expect a move like that coming out of it, simply based on how that price pattern works. As always, before we look at the rest of the charts, I want to remind you that you can watch our Market Outlook video on our Market Scholars blog. Just go to marketscholars.com, click on blog at the top of the screen. You'll find today's Market Outlook listed among other posts. Remember, on this post, if you want us to keep doing these videos day after day, the way you let us know is by 3 clicks. 1 click here by clicking on the heart on today's Market Outlook tweet. Pulls up this window, click on like. It pulls up your Twitter account that you might have to log into, and then you click on like. Click on that icon there, the image for tonight's Market Outlook video that takes you to your Facebook page. You can like it from there, right here. And then finally, this click here by liking it on the blog post. So, and the more you share those from either up here or down here, the more that Twitter and Facebook will promote this video to anyone because of the engagement that the content's getting. So the goal is to get those shares up to 100. So you can do this right now while you're watching. Just click on any of these buttons and share it across any of these networks that you have an account on. All right, if we take a look at the long-term chart for the S&P 500, you see we are still above a rising 50-day moving average, which is also still above a rising 200-day moving average, and the gap between the two lines is continuing to rise as well. So that's what this MACD measures down below. So still on the long-term basis, it was a down week. It's the first down week that we've had. We've had a 5-week winning streak before that. And even then, like I've shown you before, when you look at the Hakinyashi candles, we still didn't get a lower shadow here at all on today's candle. Now, next week, you can see the next week's open will be the midpoint of this candle here. So you see, the open and the close between 28.11. Here, let's get the old calculator out here. 28.11 and 28. And then the close of today's candle is 28.40.70. 28.40.70. So that is a 29-point difference. We'll cut that in half and subtract that from 28.40.70. So that will put the open for next week's candle on this Hakinyashi candlestick type at 28.25.99. So that's going to be the key level to watch next week, and if it's equivalent, would be the same thing You can see the open was at 280.67. 280.67. And the close this week was 283.79. So that puts us 312. We'll subtract that from 283.79. And that puts the... There we go. Finally getting the math right here. 282.23 is the key figure to watch next week. A breakdown below that, we'll take a look at the intraday chart here in a second. But a breakdown below that will produce that long lower shadow, which is what we start looking for, a reversal, a long-term reversal at that point. Now, a long-term reversal might just get us to, the 200-day moving average, if that. So it's not like the end of the world here. You can see this long-term reversal got us to where we were testing, and that was a pretty significant move in February. But we just tested the 200-day moving average and got down to it. So we're not there quite yet. And then you look at the 3 green arrows, and you can see, okay, we don't have 3 green arrows anymore, so we're not shaded green here. We have 1 red arrow. The stochastics is not quite red yet. So the stochastic, when you look at it here, oops, you can see the MACD is crossed below its moving average. Stochastics has not crossed below its moving average yet. And the price itself has pulled back to the 17-day moving average, but hasn't broken it yet. So last time we hit the 17-day moving average, we bounced. So we'll see if that continues to be the case and we rise back up and stay high on this MACD. So when you look at the intraday chart, we're still in the upper half. So we pull back to the midpoint, and that will be the midpoint for a few days. And the midpoint is going to move up a little bit when this low moves up to there, barring a new high point, which we haven't had. I mean, the high point we got was on Tuesday. That's the last new 4-week high point we got. We have been trading in the upper half of the chart, so that's a good sign. You can see all the volume down here today. So obviously lower high and a lower low. We closed in the middle of today's range, well below yesterday's range, and below last week's high point. So kind of broke this resistance here. This is support, excuse me, on an intraday basis. We gapped down below it, retested it on a bounce move here, kind of a dead cat bounce, and then the cat got buried in the ground down to the midpoint where there's another layer of intraday support. So still in the upper half of the chart, so that's actually still bullish. Not as bullish, but still bullish there when you look at it from that perspective. Remember, as I mentioned before, 282.23 is a key level next week to get a long lower shadow. That would obviously also put you pretty much in the lower half of the chart. So we won't necessarily be long-term bearish if we got to move down there, but it will definitely be a sign of weakness that will start increasing the odds of that potential long-term turnaround. Now you remember the volume here was at 77 million. I mentioned today's range was about 2.5 points. If you look at the range here, is 1.69. So if you now look over there on the left above the 4-week midpoint, it says 1.69 is the range today. Now remember, we gapped down, so we had about a 1-point gap between the close at 285.07 and the high today at 284.06. So you add that 1 point to the range, so you add about 2.69 point range. 77 million shares traded. You look at the this chart and you see 2.69, just a little bit above the average. 3 to 4 points, now you're more bearish. Extreme bearish, we're going to bounce up like immediately. 3 to 4 points, so kind of in the middle where it can grow, where this line can grow up. That would have been more bearish. 2.69, just a little bit above the average. 77 million is right here, so still relatively low within the 52-week range. 100 to 125, or up in the upper half of the 52-week range, more bearish. So same thing here. So the 2.69 is still in the lower half of the 52-week range for ATR. So it was a down day, obviously, but not down enough to say, you know what, now we're going to be more bearish. And you can see the relative ATR, which can jump up really, really quickly here, is still pointed higher today, but it's still easily in the bullish territory. And finally, the volatility index. If if you look at the volatility index here, you can see it's jumped up, but not to these new highs. Remember, this was one big low point in volatility, and look how fast we bounce up. But even then, the last time that the MACD and the stochastics was above their midpoints is right here. So technically, according to the MACD and stochastics, this would be a lower high point on volatility. Now, I don't think that, we're gonna, if this holds, we're gonna break down to a lower low point. But because I thought that was pretty darn low there. But regardless, that this kind of shows you, first of all, that wasn't that big of a jump in volatility, and second of all, it didn't jump up as high as the last peak that we had in volatility. And when you look at it on a relative basis, you'll notice that volatility here is actually still in the bullish sweet spot. It got up to the bullish sweet spot early this morning, a little bit of a jump late in the afternoon, but you're still kind of in that bullish zone. So we held the neutral area for a resistance, and we're still in the bullish territory for volatility. And now that it's got a peak to fall from, volatility can grind its way back down here. Keep in mind the seasonality of, once we get about to middle August, and we even kind of talked about by the end of this week, that into the end of the month, volatility tends to rise. So that's from a seasonal standpoint, that's, the intermediate trend is bullish. That would suggest weaker volatility. So, we kind of go with what the current trend is telling us, but we're aware of the seasonal factors. It can definitely take that into account in terms of how we manage risk on any positions that we're entering or any current profits that we have in existing positions. So in summary, we had a pullback today. Obviously, it was kind of confined to areas where the dollar has a bigger influence and impact. The pullback was not broad-based. The IWM outperformed the large cap stocks, so it wasn't as broad-based, and it was actually more international, as you'll see here in a minute, what caused us down. So the weakness still isn't enough yet to change the trend. We still have expectations for bullish trends, and when you get short-term pullbacks like this that are simply Fibonacci retracement moves, even on just a short-term basis, they can still be viewed as buying opportunities. I know a lot of people talk about, I'm waiting for that pullback. I'm waiting for something to get in. I'm waiting for this to happen. I'm waiting for that to happen. If waiting for pullbacks is your thing, even on a short-term basis, here's an opportunity. Now, like I said, it doesn't mean that you can't balance an active portfolio with some bearish positions, as we'll see today. But it doesn't mean that we have to balance our whole portfolio and tilt our whole portfolio towards safety and bearishness because we think that we're now entering in a bear market zone, because obviously the charts don't suggest that, and the charts suggest that we'll just bounce off of this and continue to grind our way higher. So that being said, love to hear your thoughts. Do you agree or disagree with that? And on a day like today, I wouldn't be surprised if I had some more disagrees on the poll. So there's a poll popping out in the top right corner of your screen. Click on either one. If you click on disagree, scroll to the bottom and comment on what you see that's different. Now, I don't want to hear that you just think the markets are bearish and they should fall for whatever, that's because that's just what you always thought it should do, and that's what it will do. Tell me what you're seeing, the evidences maybe that you're seeing that you look at on a regular basis that would suggest that we should be a lot more bearish than what we're looking at this as simply just a short-term weakness. So let me know down in the comment section below. All right, now let's take a look at the different intermarket relationships here. We'll start off looking at the asset classes and how things performed. You can see stocks across the board here all fell. So this is real estate stocks, REITs. Over here, dividend stocks pulling back, preferred stocks pulling back, MLPs pulling back. So stocks across the board. Here's some representative equities. You can see municipal bonds rallied, long-term treasuries rallied, foreign bonds rallied here, and then of course high-yield corporates, which behave similar to stocks, fell. So they all dropped. On the other end of the spectrum, you can see crude oil bounced up on the commodities, crude oil bounced up a little bit off of some sharp low points it had. Agricultural commodities getting caught up in the trade winds. Gold still down with the dollar breaking out. Look at that breakout move on the dollar. So there's your dollar up there. Long-term bonds rallying, dollar rallying. Gold was up there too. So it was a little concerning that gold was up there, because when the three of those are the top performing assets in a given day, that's about as safe haven of a day, or risk off of a day, as you can possibly get. What would make it more risk off is if IWM is actually down below the S&P 500, in which case it wasn't. Also, if crude oil was down here too, that's the most risk off you could possibly get. So the fact that crude oil's rallied, gold pushed down, and there were some, you can see investment grade bonds did okay, along with most of these other income related asset classes. It was a down day, and it's reflected in how these assets perform. But if you take a look at how it was down relative to other of the major economies out there, you'll notice the S&P 500 had the best day. Canada had a good day too, relatively speaking, right? Down 1%, but China wasn't down as bad. India wasn't down as bad. Look at some of these others. So, I tweeted this out earlier today. 6 of the top 12 largest economies in the world were all down 2.5% or more on the day. The S&P was down 0.75%. The Russell, which is actually a higher beta and more aggressive than the S&P, was only down 0.25%. So again, perspective. If you're looking at Germany here at this chart, you'll see, it's down 10%. In fact, look at these. Of the 12 largest economies that you have, you'll notice we have one, two, three, four, 5 of them. They're down 10% or more in the last 3 months. That's correction mode. And, again, usually corrections are down. Most of these, the highs are really close to the 3-month period. That's correction mode. China's down 11%. Korea is down 13%. Germany is down more than 10%. Italy is down 17%. That's like the emerging market of Europe. And to new 3-month lows, too, for Italy. Who else had? Russia also had down here 3-month lows, as well as Korea 3-month lows, and United Kingdom 3-month lows. So, if you're a UK investor, or if you're a German investor, two of the largest economies in the West, outside the U.S., you're down 7.5% to 10%. And you're down even more than 7.5% from the peak. So you're closer to being down 10% here in 2 of the largest economies in the Western. In the West, again, outside the U.S., the U.S. is up 4%. So that kind of puts into light, how bullish or bearish we can be. If investors were really skittish, that they were not willing to put their money in stocks anywhere, then you would see, gold up here. You would see gold and dollar and the bonds all rallying. The safe haven is all get out, and everything risk averse. The riskier, higher beta plays like commodities, like small cap stocks would all be down here. But that's not the case, right? The U.S. market continues to be the market that's preferred for investors, because everything else looks unbelievably horrible. And all these other, these are not like small cap stocks here. These are the biggest economies in the world. Japan and China. They don't get a lot of, China gets a lot of press right now, but it's down more than 11%. Japan's down 5.5% over the last 3 months. Really, India has been unscathed, but everywhere else, and Canada's been a little bit unscathed too. Everyone else is showing some deep, deep losses, and that just helps the U.S. even more, as it and India are really the only ones in Canada to a degree. But that Canada chart, if you stay below that line, is going to turn yellow. Brazil is going to turn yellow too. So these are going to be the only 2 that show green moving averages, which means you're above a rising moving averages. You're yellow, pretty much at least yellow everywhere else, if not turning red. Which, the difference between a yellow line is you're below a rising moving average, that makes it yellow. If you're below a falling moving average, it makes it red. So, that's not a, you've got to park your money somewhere. And, if gold were higher along with the dollar in bonds, then it'd be risk off. But the fact that, it just looks like people are parking their money inside of U.S. assets, including long-term bonds, including municipal bonds, including mortgage-backed securities, including, to a degree, U.S. stocks. All right, if you look at how the sectors have been performing, look over here on the left, we only had one sector that was up, and energy stocks benefited from the rise in crude oil. I wouldn't really be too bullish right now on energy as it continues to this trade still below a falling moving average, so it's red, but pretty sideways there. But you can see, safe haven, staples, utilities, healthcare, your typical safe haven areas are all the other outperformers of the S&P 500. But look, you can see the biggest losers were materials and industrials, financial struggling, financial struggling with the falling yields, real estate struggling even with the falling yields. So it kind of shows some weakness in that particular sector. But industrials and materials, those are the areas that get hit the hardest by these trade wars and these tariffs. In this case, today with Turkey more than anybody. That's what really weighed on the markets from a global standpoint. And you can see it showing up here too. And you can see the typical behavior on a down day among the U.S. markets themselves. So when we're looking for an individual trade, you might have seen this earlier, I had this up here. When you're looking for an individual trade, for a bearish trade, to provide some balance, the problem is, remember, the broad market's actually pretty bullish. And your leadership here, your discretionary technology, they're still the leaders. They might have lagged a little bit, the S&P today, but not by much. So it's not like we're falling off a cliff right now and we can be aggressively bearish. We have to be very tactically bearish because of the strength in the long-term trends of the market, of the broad market and the sector rotation which supports that. So you look at a stock like WIN. WIN is not strongly, it's not bullish at all. It's not been following the market. In fact, it's been really declining sharply with the strength in the U.S. dollar impacting this company pretty negatively. So you look at, for example, its market forecast chart, and you can see, oops, defaults to that one. Let's pull up WIN. You can see it's got a dark pink shading, which means that we are back to strongly bearish, right? Because we're below the 50th percentile and it's turned back down. And you can see we've been pretty much on a strong bearish move. It got close to crossing above 50 here, but no strong green. So this is one big intermediate run to the downside here that we're on. And you look at the long-term charts for WIN, and you can see, we're breaking down below. In fact, last week was a big break below the 200-day moving average. We've broken down below it, got up to it, gotten down below, and now the 50-day has given us a death cross, a cross of the 50-day below the 200-day moving averages. You look at some of the other indexes, like other indicators like the Bollinger Bands. The bandwidth is rising. We're easily in the lower half of the band width here. We had already dropped below. And if you notice, we're getting kind of a dead cat bounce here where we had a big drop outside of the Bollinger Bands, significantly outside the Bollinger Bands. We came back up to the top of the gap, or to the bottom of the gap. So there's the gap right there. We came back up to the top of the gap, or excuse me, top of this move, the bottom of the gap, held it for resistance, and now the cat is falling back to the ground. So the dead cat fell out the window, hit the ground, bounced, and now you would expect it based on the price pattern to get buried in the ground. You expect a more bearish move. You can see this other chart here, the DMI. The bearish line, the negative line, is easily above 25, and the trend is below 20. So this ADX is in a trend-ready state, which means we can start a new trend. We had a trend, a bullish trend developing here. We've been trendless as it's fallen back below 20. That's pretty much in this area. And now, like I said, breaking back down. So there's a bearish opportunity there. And if you look at its options, that September option 42 days out, we can look at selling the 155 and buying the 160, trying to get $1.16. That gives us a 30% return on risk. And if you look at it on the Analyze tab, we got about a 73% chance of making money with that trade. Throwing that break-even price onto the chart, it puts the break-even up above that level. So if we do go back up, as long as it stays below that high point, which is where the break-even line is, remember that high point's right here. If we get above that high point, you can see we'll lose about $1, $116, $119, $118, which gives us about a 1-to-1 reward to risk ratio, and that's when we'll take off the loss. So get out of there, move on to something else. But if we stay below that low point, we continue down even, you see if we continue down, we'll steadily get gains up towards the maximum. And as time passes, you'll see that purple line just will inch its way up. And the break even for today continues to move over here as time passes. So you can see where the current price is. If we weren't to move at all, eventually we'll just rack up the gains just from time movement. And of course, if volatility comes up a little bit, that will weigh down. You see that brings the purple line down. So if the stock falls and brings its volatility up, it will be a little bit of a weight, but not enough to keep the purple line from eventually getting to that maximum gain. So we have a bearish opportunity. We're a little tactical here, but we're taking advantage of a stock that is really feeling the pressure of that strengthening dollar and with that showing us some bearish patterns across some of its charts. And you notice here on the 3 green arrow charts, the last chart to look at, it's got we're trading down below the 8-day moving average. We're trading below a falling 17-day moving average, which will eventually get below that blue line where the break even is. And you can see the MACD and the stochastics down, falling and low as well, showing the bears are in control for this stock. So that does it for today. Thank you very much for listening to tonight's Market Outlook. Tell me what you think. Click on the link that's popping up in the top right corner of the screen. Sorry about that. And let me know what you think about tonight's trade idea. Let me know what you think about the market posture. Do you agree? Or do you have any questions about what we talked about? Do you have any questions about something we didn't talk about? Let's talk about it in the Market Outlook forum. There's a great market scholars community that some of whom have been listening to these videos for literally years. So any questions or comments, make sure that you bring them to the community and you'll be taken care of there. So again, thank you. Remember to subscribe to our YouTube channel. Like today's comment by clicking the thumbs up icon. Comment down below. Follow me on Twitter for more content like this. And join our Market Outlook community on Facebook. Again, thank you. Have a great weekend, everyone, and we'll see you all next time.